Hi, good morning to all. Welcome to today's Daily Dose of Market Insights, presented by myself, Kelvin Wong, the market analyst of OANDA Asia Pacific. So, very good morning to all. Today will be Tuesday, 3rd of October. Okay, very good morning to all. Okay, very good morning to all. Welcome to today's Daily Dose of Market Insights, brought to you by OANDA, presented by myself, Kelvin Wong, the Senior Market Analyst of OANDA Asia Pacific. So very good morning to all. Today is Tuesday, the 3rd of October. So before we start our usual daily dose of market insights, let's take a look at the disclaimer slides first. All right, so leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy, sell, nor financial advice or recommendation for any investment product. All right, so as usual, this is our three key takeaways that we will actually cover in our daily dose of market insights. It will be a recap of what happened overnight in terms of events, economic data releases, as well as movement in the major asset classes. Then secondly, we will also cover what are the key events and economic data releases to look out for throughout the whole of today, from the European session, from Asia session right now to European session, all the way to the US session. And lastly, we will round up with a short-term technical analysis outlook on the broad-based asset classes. So basically, let us start off what happened overnight. So overnight, we talk about the US stock market performance first. So overnight over here is that the performance in US stock market is more rather lackluster. Why? Because there's only one particular major index that has shown positive return, which is the Nasdaq 100 is up 0.83%. But the rest of the major indices, S&P closed unchanged. The Dow Jones actually inched down much lower to negative 0.22%, and the Russell was the worst performing at negative 1.58%. So overall, let me show you the heat map of the S&P 500 of the individual component stocks. All right. Okay, so now let me share the other screen so that you all could see. Okay, so what I could see over here is that this is the heat map. Okay, so let me basically focus more on the screen. Okay, so what I could see over here is that yesterday almost the US stock market, based on the S&P 500 as a general we call it benchmark or gauge, is almost in the red with the acceptance of the 7 mega cap stocks that actually managed to hold the fort. So this is not a very healthy breath instead. So I would say that the particular Nasdaq 100 is the outlier. So if we could recall those who joined our we call it call yesterday, we still maintain a short-term we call it bullish condition bias on the Nasdaq 100 for that counter trend rebound, that minor short-term counter trend rebound. So yes, the Nasdaq 100 indeed rebounded and retested the resistance level that was mentioned yesterday. But however, the other major major US indices continue to actually shape lower low, and I would say that there's actually a high likelihood that they are actually now in the midst of what we call it kickstarting another leg of potential impulsive down move. So later I'll share with you the chart, the short-term technical analysis chart of the Nasdaq 100 and as well as the Dow Jones Industrial Average. So the Dow Jones actually broke below our key short-term pivotal support yesterday, which actually negated or invalidated this potential counter trend rebound in the Dow Jones Industrial Average. So yesterday, what we could see is only an outlier that is happening in the US benchmark stock indices that is only being held up by the 7 mega cap stocks, which is actually indicate to us that we are still in a very weak technical breath for the benchmark US indices. So what causes this weak technical breath of the US benchmark indices is due to the fact of that rising yield curve. All right. No, pardon me, rising long-term benchmark 10-year treasury yield. So you look at the longer treasury yield yesterday, it actually closed higher and surged past last Thursday high. So yesterday it went all the way up to 4.7%. So that's actually close to a high that was last seen in September 2007 before the Lehman Brothers crisis. So the next resistance we are looking at is with 4.9 versus thereafter with 5.2%, which is the key resistance level, key major resistance level. So what is 5.2%? If you look at the monthly chart over here, 5.2% is in fact the former swing high of June 06 and June 07. So that is a pretty major resistance to look at. If the 10-year benchmark US Treasury managed to surpass the 5.2%, I think we could start to see a very strong trend of higher interest rates going forward into 2024. All right. So, but for now, this key medium-term outlook on the US 10-year Treasury yield still skewed towards more on the bullish side. That means, i.e., we could potentially see further downside pressure on the US stock market, especially the benchmark stock indices, and may potentially start to spread to the rest of the world. That means we're talking about further weakness in equity prices due to higher potential longer term US Treasury yield. That means indicate us that the medium term to longer term cost of funding will have a higher likelihood of increasing much as a higher level in the next 3 months or so. All right. So the only indication that this 10-year US Treasury yield got to actually inch downward or reverse down from here will be pretty much pivotal towards the next US Federal Reserve Fed Fund meeting in November, where if the Fed start to give a guidance that they are ready to actually cut interest rate in the second half of next year, then we could see some tempering of this very resilient medium-term upward trending US 10-year Treasury yield. Okay, so that's for the US stock markets. And also given the fact that this longer term US Treasury yield that is slowly inching upwards, the dollar also benefited from it. So what we could see over here is that yesterday we see a resurgence of dollar strength spreading throughout almost the entire FX space, where the weakest was the sterling. So the dollar actually rallied the most against the sterling, followed by the Swiss, followed by the European currency. All right, so these are the what you call top three dollar strength, that is top three dollar strength that's being seen in the European currency. So it's the rolling 1 month performance. So all in all, this dollar counter trend retreat or a counter trend dollar strength pullback that was seen on last Friday has more or less ended, and right now we potentially see the resurgence of further dollar strength going forward into potentially this week. All right, so even the dollar CAD has really started to the dollar CAD has started to rally strongly as well. Then followed by the dollar Aussie against the Aussie against the Sing, and the one that is still holding back will be the dollar CNH, whereas potentially there could be signs of what I call intervention from PBOC, okay, to actually cap the CNH from strengthening too much against the dollar. But all in all, in a nutshell, majority of the FX pairs is actually weakening against the dollar. That means, i.e., we start to see dollar strength resurging coming back into the market. All right. So now, what are the key data releases yesterday? And so, what is the key data releases yesterday is, if you look at the economic data release, is the ISM Manufacturing. So due to the fact that this stronger than expected ISM Manufacturing PMI, which came in at 49, is still below contraction mode. Anything that's below 50 is anything that is below 50 is still contracting. So it's 49, but it managed to surpass expectation of 47.8 and above the previous month, August, of 47.6. So indicating to us that the manufacturing sector in US is slowly recovering from its prolonged or persistent contractory mode. So that actually supports what I call the Fed narrative right now in terms of their interest rate expectation. That means, i.e., the current high level of interest rate that they actually invoked 1.5 years ago has not seen much detrimental or major negative impact towards the US economy. So, i.e., that actually keep them on the feet to maintain interest rate at this particular higher level for a longer time period. So that actually also reinforce that movement in that US 10-year Treasury yield yesterday, which has this negative feedback loop into the stock market and positive feedback loop into the dollar strength. Okay, so let's look at the trend of this ISM manufacturing over here. So if you look at the trend of the ISM manufacturing, notice that it slowly starts to recover from the worst point hit was April, May, June, somewhere around June this year at below 46. So right now it's coming close to a year high at 49, but still below the 50 level mark, below the contractionary mark since November last year. But all in all, there's some signs of recovery in the US manufacturing sector. And also yesterday, there was a couple of news, Fed speak, I would say. So based on Powell spoke yesterday, but he did mention about comment any near-term outlooks on rates. So he did say the same old thing during his press conference, saying that price stability is a bedrock of the healthy economy. That means he's still looking at more evidence that inflation pressure got to actually starts to temper off in US before indirectly he's implying before they decide on the next rate move or rate cut. So his particular concern is still price stability rather than the current higher interest rate level that was invoked by the Fed in the last 1.5 years, its potential negative we call it repercussion into the economy. So he's rather concerned more about price stability versus economic downturn at this point in time. So but then his colleagues who spoke yesterday was this another Fed official, but he did say that Fed is likely at or very near sufficient restrictive rate. So what he means that over here is that more or less is coming close to a terminal level in terms of the level of interest rate or the Fed fund or the level of interest rate in US. All right. So it seems that very likely at most one more interest rate hike before 2024 ends. Then from there, the Fed will stay put for a period of time. Okay. Then one particular news I highlight is Tesla. So Tesla, as you all know, that is one of the mega cap stock in US. So what is hinting over here is that delivery starts to slide for Q3 due to a factory downtime issue over at this point in time. So that's actually a kind of a negative news flow for Tesla. But however, sometimes you know that price action moves irrationally to news. So yesterday, Tesla was one of the top performer in the major within the S&P 500. All right, but in the longer term, we do need to take into consideration, given the fact that if this delivery continue to slide due to what I call economic softness, that could potential cause a Tesla trend to actually be more on the downside than upside from a longer term perspective. Okay, now the key thing over here is that what are the things to look out for today will be for sure right now, since we are talking right now about close to 15 minutes time from now, we have RBA interest rate decision out at 11:30. So market still expecting stand pat for the I believe that it will be the okay, so that should be the third consecutive month of okay, let me double confirm. That should be the yes. So that will be the fourth consecutive month of keeping rates unchanged at 4.1%. If the new RBA governor continues to actually take the cue for market expectation, due to the fact that over in Australia, we now start to see a bit of mixed reading from this current level of high interest rate. We have kind of still robust unemployment market, but however, inflationary pressures has started to actually temper off in the Australia economy. So that could actually support this unchanged movement of policy rates for RBA to keep it at 4.1%. So how does that reflect the dollar in the Aussie dollar? So later I'll share with you in the short-term technical outlook on the Australia dollar. All right. So going forward, what other key data to look out for the rest of today's Asia session will be over here. If you look at for European session over here, it will be pretty quiet. Then thereafter in the US session, we have this not really very exciting job numbers, but it's something that the market that pay for is called the JOLTs Job Opening. But nevertheless, this will be give a bit of prelude to this Friday non-farm payroll data. So this will be a key data to actually look out for I will say that the sole key data to look out for in the US session that is out at 10 p.m. Singapore time. Then at 8 p.m. slightly early, there's another Fed official public speech called the Fed Bostic will be at 8 p.m. Singapore time. All right, so these are the key we call it economic data to actually look out for today's trading day. So now let's jump into the technical picture. So let us start with the FX market first. So for the FX market over here, let's quickly take a look at the Australia dollar. So for the Aussie dollar over here, so this is the 1 hour chart, the Aussie dollar. So Aussie dollar, what I could see that is very clearly broken down below last Thursday's swing low and 5th of September swing low over here. So that's actually a bearish breakdown from this consolidation that has been taking shape since 17th of August this year. Okay, so at this point in time, the RSI has been now in the oversold region, the hourly RSI, but there's no bullish divergence, indicating to us that this downside move since the high of last Friday after that counter trend rally, the momentum is still pretty intact on the downside. Short-term momentum still remains bearish. But however, given that it's in the oversold region, potentially we could see a bit of minor bounce coming into place for the Aussie dollar at around 63.75. But we'll be using 64 figure level as the key short-term pivotal resistance, which is slightly below the 20-day moving average. So that should actually be a level, a make or break level, to maintain this ongoing short-term bearish condition on the Australia dollar, given this we call it bearish breakdown from close to about a 4-week plus of consolidation range on the downside, with the next support coming in at a psychological level at 63 figure level, followed by 62.70, which is the 3rd of November 2022 swing low. All right, so bearish, short-term bearish bias condition on the Australia dollar. So however, if you start to see a clearance above the 64 figure level, that means if you see an hourly close above it, that means what we could see over here is that we may start to see another round of choppy corrective rebound movement to retest the 65.10 range resistance level that is in place since I would say that 30th of August and 1st of September high, and as well as this 20th of September highs. That is this particular we call it a medium-term range resistance. All right, so watch the 64 figure level on the Australia dollar, the Aussie dollar, as RBA meeting looms ahead. Okay, so now the next one will be the other FX pair will be the dollar yen. So dollar yen no change. We still maintain that bullish bias that we have yesterday, as price going to churn slowly upwards, holding above 49.16. That's our key short-term pivotal support that we have for yesterday. The next resistance to look out for will be 150 figure followed by 150.30. Then thereafter, this major resistance at 150.80/90. So what's 150.80/90? Will be this on the daily chart. It will be that swing high area of 21st of October, not taking into the upper candle, but rather the upper body of these two candle from 20th of October and 21st of October, conferencing at 150.90. All right. So for sure, a break below 149.60 level, then this short-term bullish bias condition will be invalidated to see a pullback or corrective, a minor corrective decline to retest the 20-day moving average. Now also acting as a support level at 148.40/148.05. Okay, now very quickly, switching to this other FX pair will be the euro dollar and the sterling dollar over here. So let us quickly go to the euro dollar. So euro dollar yesterday, right, we actually using that 109 105 10 level around, that means the last Thursday level, swing low level, to actually maintain that potential counter trend, short-term minor counter trend rebound. But however, price action broke below it, so it validated that counter trend rebound that has taken shape on last Thursday all the way up to Friday. So this is more like a short-lived counter trend rebound rather than an extended one. So right now, this impulsive down move on the euro dollar has resumed That means we in this medium-term downtrend that is still in place since the high of 18th of July. So now the next support level to look out for will be at this 104.20. So using 105.60 as the key short-term pivotal resistance to actually kind of maintain this short-term bearish bias condition on the euro dollar. However, a breakup above 105.60 will invalidate this bearish bias condition to see a squeeze up to retest the 20-day moving average, also conferencing with the former minor range support of 21st of September 15th of September to 21st of September, now acting as a pullback resistance at 1.0630. All right, so flipping to a bearish bias condition on the euro dollar below 1.0560. Okay, now very quickly on the sterling dollar, similar fate as the euro dollar. Yesterday broke down on this support level that we highlighted at 121.10 level, so invalidating that we call it that extended short-term counter trend rebound scenario, now flipping to a bearish bias on the sterling dollar to continue its impulsive down move within its medium-term downtrend using 1.2185 as a key short-term pivotal resistance. So the next support level to look out for in the short term will be 120.50 followed by 119.60. However, a breakout above the 121.85 key short-term pivotal resistance will invalidate this short-term bearish bias to see we call it a squeeze up to retest the 1.2270 resistance level, which is the swing high of 29th of September, and this consolidation zone over here at 21st of September and 23rd of September, and so coming very close to the 20-day moving average that is sloping downwards. All right, so but nevertheless, over here, right, the hourly RSI has dipped into the oversold region, but there's no bullish divergence. So what we could see is maybe a potential minor kind of a bounce up towards back towards the yesterday's swing low level, or the Thursday swing low level, now turns into a pullback, minor pullback resistance at the 121.10 followed by the 121.30 level over here. Okay, but as long as the 121.81 level is not surpassed to the upside, this movement on the sterling dollar is more potentially skewed towards the downside to kickstart another leg of impulsive down move potentially. Okay, so that's for the FX space. So overall, the FX space, what you see over here is dollar strength resurgence. So now moving on to the indices. So today, the Hong Kong 33 index reopened. Mr. Han Seng has really reopened for today. Still bear in mind that before we go for a break on yesterday with the closure, we're looking for that particular counter trend bounce. So that counter trend bounce kind of a day more or less been completed, take shape after having a failure to break out above this minor descending trend line resistance that is in place since 4th of September swing high. So today's price level has broken down below the low of last Tuesday and last Thursday at 17,370. So that was actually the pivotal support level, the short-term pivotal support level that we have on last Friday. So given the fact that this level has been taken down, we could actually say that now the odds are now skewed more towards the bears to actually resume this downtrend movement, at least in the short term, towards the next support level at 17,060 followed by 16,800, as long as 17,680 key short-term pivotal resistance holds for today. However, if we start to see a reversal upwards and break up above the 17,680 level, then this particular we call it bearish bias condition will be negated to see a messy choppy upward movement to retest the 22nd of September swing high area at 18,160 followed by 18,370, which is also close to the 50-day moving average. All right, so now going on will be the German 30 index. So for the German 30 index, yesterday we were actually using this area at 15,290 to look for the counter trend movement back towards close to the 15,560 level, 15,600 level, which is the 200-day moving average. But however, price action refused to actually hit up higher, and thereafter it actually broke below that short-term pivotal support have yesterday and going to shape lower high, and with the RSI now having that bearish condition as well on the hourly RSI, indicating to us that that particular downside momentum has resumed. So i.e. The German 30 index now is resuming its impulsive down move within this medium-term downtrend that is in place since the high of 31st of July. So we'll be using this level here for today, 15,330, flip to a short-term bearish bias condition for today looking towards a test on last Thursday and Friday swing low at 15,130. Below it exposes the next support at 15,020, 14,930, which is the congestion area here of 20th of March and 22nd of March, and as well as the lower boundary of this medium-term descending channel that is in place since 31st of July. All right. However, if we start to see a breakup above 15,330, then we will start to see another the resurgence of that counter trend rebound of I would say the minor counter trend rebound to retest the 200-day moving average, now acting as a resistance at 15,560. We saw confluence with the former swing high, the minor swing high area of 22nd of September and 25th of September. All right, so flipping to a short-term bearish bias condition on the German 30 index for today, holding below 15,330. Okay, now moving on to the US stock indices will be the Dow Jones. We call it the Wall Street 30 in our platform. So yesterday we do have a short-term bullish bias for that extended counter trend rebound, using that Thursday swing low area around 33,340 as my key short-term pivotal support level. That support level got broken down on the downside. So overall for sure that over here, what you could see over here is that yesterday movement has started to indicate to us that this Dow Jones Industrial Average or the US Wall Street 30 now has continued to kickstart another round of impulsive down move within this medium-term downtrend that has starting to take shape since the high of 15th of September. All right, so all in all, right, what we could see over here is that there is very clearly a rejection of at the 200-day moving average, which was seen on last Friday. So over here on Monday, this price action attempted to actually come close to it, rejected as well, and going to inch lower to print a lower low. So all in all, right, what you could see over here is that the bearish momentum has already has started to resurface again. So right now, based on the current technical picture, very low chance of the extension of that potential counter trend rally. So we'll be flipping to a short-term bearish bias condition holding below the 33,770 key short-term pivotal resistance to look for a test on the next support level at 33,160, followed by 32,990, which is also the lower boundary of this ascending channel that is in descending channel that is in place in 21st of September, and as well as confluencing with this minor congestion area of 1st of June. All right, but however, if we start to see a break up above 33,770, then that particular counter trend rebound scenario will start to re-emerge again to see a test on the next resistance at 34,150, which is the which confluence with the 20-day moving average as well. All right, so that's for the US Wall Street 30. Now, very quickly for the Nasdaq 100. So Nasdaq 100 is the one that's holding the fort, but given the fact that it's the current US stock market is more skewed towards the downside rather than the upside. So very likely, right, this Nasdaq 100, yesterday we have a bullish bias holding above 14,465. So very likely we're now coming very close to the potential last leg of that counter trend rally. So that could potentially take us to the next resistance level at 14,980. So what's 14,980 if I were to actually draw that Fibo retracement from the high of 15th of September all the way down to last Thursday low is at the 38.2%. Sorry, 50%. So we'll be using the 61.8% golden ratio, which is so close to the 20-day moving average, 15,140. So potentially another test of 14,090. But given that the price action hasn't reached this level yet, I do not know how the price will react at this level at this point in time. The RSI also in the middle of nowhere, slightly above 50, hasn't hit the overbought level yet. There's no clear signs of a bullish divergence at this point in time. Or bearish divergence at this point in time, so indicators there could be a push up. So but I do not want to have 14,980 as the key short-term pivotal resistance just to go for a whipsaw, so I'll be using a slightly above it at 15,140. So around this area here, 15,140, potentially the Nasdaq 100 could actually shape that bearish reversal. So as long as 15,140 key short-term pivotal resistance holds, this Nasdaq 100 potentially could actually shape a downside move to retest 14,645. Below it exposes the next support level at 14,445 / 14,370. However, if we start to see a clearance above 15,140, then we could see an extension of this counter trend rebound scenario to much more steeper towards the pullback resistance of that former ascending trendline support has been taken up, now acting as a resistance at 15,550, also confluencing with the minor swing high of 4th of September all the way up to 15th of September. So right now flipping to a bearish bias condition on the short term for in the short term for the US Nasdaq 100 after this potential last push up towards 14,980 using 15,140 as a key short-term pivotal resistance for today on the US Nasdaq 100. All right, so that's pretty much sum up on the US on the major stock indices. So as you all know that the dollar strength right now is taking a bit on gold as well. So gold going to plummet on the downside to I think towards a almost another close to coming close to the 18 figure psychological level. So now let's take a look at the chart before we go on the XAU slash USD. Okay, so okay, very quickly the chart of gold. Yeah, this gold spot gold that means against the dollar. So what we could see over here is that previously on last Friday we were actually looking for the counter trend rebound. So the counter trend rebound that take shape 1874. Then thereafter it going to slide down much lower. All right. Okay, by another 3%, 3% down move. So we could see right now over here is that this current potential slide down in gold has now reached a key medium-term support level at 1820/1808. So what's this level, right? This level, in fact, is the lower boundary of this major descending trend line that is in place since 4th of May high. And as well as if we go to the daily chart over here, okay, is close to the swing low area of 24th of February and 8th of March, all right, at this 1820/1808 level. Okay, so given the fact that we are now coming very close to a key longer term support level, so yes, we do not see any signs of a bullish reversal yet. There is no clear signs of a bullish divergence this time round. Price action still, yes, RSI is oversold, price still going down lower. You can see over here RSI lower low as well. There's no bullish divergence here yet at this point in time. So, but given the fact that we are now approaching a key graphical support level at 1820/1808, so I'll be having more of a neutral stance for today on gold, spot gold. It means the XAU/USD between 1820/1808 and 1845, which is this downward sloping moving average as well. The 50 period moving average, taking account the hourly chart. So neutral between 1845 and 1808. Only a clearance above 1845, then we could see another round of counter trend, short-term counter trend rebound to retest the resistance level. The next resistance level at 1874/1885. However, if this 1808 is going to break down, then this impulsive down move resumes towards the next support level at 1780 for spot gold XAU/USD. All right. So given the fact that spot gold now is approaching a key medium-term support level, we will have a much more neutral bias instead on spot gold at this juncture. So with that, we now reached the 33-minute mark. So these are the key highlights I want to highlight for today. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.